Have you ever wondered why stock prices move up and down every second? One moment Reliance is 2900 rupees, next it's 2920 rupees. But who decides that? Today, we'll break down the real engine behind every stock's price movement, demand and supply. And by the end, you'll understand what really drives prices in the market and how smart traders use that to their advantage.
Let's start simple. A stock price isn't fixed by the company or the government. It's determined in the market through millions of people buying and selling shares. Every time someone buys or sells, they're making an offer. Buyers say, I'll pay 100 rupees. Sellers say, I'll sell at 102 rupees. When they agree, that's the new market price.
The stock market works like any other marketplace. Whether it's vegetables or gold, the law of demand and supply decides prices. When demand is greater than supply, price rises. When supply is greater than demand, price falls. Example: if investors suddenly believe Infosys will post strong earnings, more people want to buy it. Demand spikes, but sellers are few. To get the stock, buyers are willing to pay a higher price and boom, price moves up. Now flip it. If bad news hits, people rush to sell, but buyers vanish, supply overwhelms demand and prices fall. Behind every price tick is a battle between buyers and sellers in what's called an order book. Buy orders are placed at different prices, 99, 100, 101, and sell orders at 102, 103, 104. When a buyer is impatient and buys at 102, the lowest sell offer, that becomes a new market price. If more aggressive buying continues, prices climb. If aggressive selling dominates, prices drop. The price moves to where the next trade happens. Think of it like an auction. The highest bidder wins until someone else bids higher. So what makes investors buy or sell in the first place? Here are the biggest factors that move demand and supply. Company news. Good results, demand rises. Bad results, supply increases. Market sentiment. If the Nifty is rallying, traders feel bullish. Demand increases overall. Economic data. Inflation, interest rates, GDP growth all change how investors value stocks. Foreign investment flows. When FIIs buy in bulk, they create massive demand. When they exit, supply floods in. Technical factors. Traders react to support, resistance levels, breakouts, and volume surges. These forces constantly shift, creating a dynamic tug-of-war that makes prices move every second.
Smart traders track demand and supply zones on charts. They watch volume because high volume often shows strong demand or supply pressure. For example, if a stock breaks a resistance level with high volume, it's a sign demand just overpowered supply. Similarly, if prices drop with heavy selling volume, supply is clearly dominating. The goal is not to predict perfectly, but to recognize when one side, buyers or sellers, is taking control.
Let's take a real-world example. In 2023, when HDFC Bank announced its merger with HDFC Limited, demand skyrocketed. Buyers rushed in expecting long-term growth. The price surged as demand outpaced supply. But after the merger, when profit-taking began, sellers dominated and prices corrected. Same company, same stock, but demand and supply flipped.
If you found this explanation helpful, make sure to hit the like and subscribe button to Trading with Krish. This channel is all about breaking down the stock market in a way that actually makes